Good afternoon, Jonathan Camarda, Chief Investment Officer. Hopefully you're all doing well. Coming to you October 30th of 2022 with the week that is coming up as well as the month that was of October. So we'll start with a monthly recap. Generally, October is looked at one of the most cruelest months of the year. However, not this year. It was the second best performing month of what has otherwise been a pretty miserable 2022. And within that performance value, as you probably noticed, is outperforming growth big time. So your companies that are essentially in your healthcares, your energies, your materials, your industrials, your financials, outperforming, of course, your discretionaries, your technologies, and the such. And what you'll see is a lot of your strategies that we've been doing some equity buying to take advantage of this month have been more in those value components of the market, you'll probably notice, with very little exposure continued under more aggressive technology and discretionary type companies. Best performing strategies of the month, even with some money on the sidelines, was opportunistic growth and income, which again is a value stock strategy, focuses on cash flows, income statements, balance sheets, and basically dividend payment capabilities. So again, talk to your advisor as far as what your sleeve looks like, but value definitely has been doing well. So now I wanted to focus on the tech wreck, right? Not to be confused with the tech check on CNBC, which I'm not sure why they haven't even changed that hour to something else, given how bad tech's been this year. But the tech wreck. So let's look at the headwinds for tech, right? It's very difficult. If you look at technologies, they're valued so high, most of these names, and you saw with earnings this week, maybe aside from some names we won't name, perhaps the CEO's head is in the clouds within goggles or glasses. We'll leave it at that. But most of these companies, the valuations are sky high, no pun intended. And so what you have is that they have to continue to innovate to generate higher earnings. And this is under the weight of inflation, where fixed costs are going up. It's not so fixed, right? Your rents, your energy costs, your employment costs. And a lot of these technology companies are also dealing overseas. 50% of some of their revenues are. And of course, the strong dollar, which we've talked about infinitum here on this telecast, has not been helpful either, right? Because that is a headwind as they're trying to sell their services overseas with a strong currency versus weaker currencies, making it more expensive for those foreign consumers. So that has been the tech wreck, and that's why we have very little representation. You always keep a little staple in there, but very little relative to some of the other sectors. Now, beyond that, what we're looking at as well is this is generally a seasonally strong time of year, which is why you have seen some of the equity buying that we've done. And as such, as it generally glides through midterm elections and the seasonality of elections in confluence with the time of year, generally and historically has proven to be an updraft through the end of the year. Now, this year has been certainly rough for rallies, as June, July proved out. And certainly we have a prudent exposure, again, to more conservative assets to offset, with small components in our equities and risk assets to take advantage without being caught blindsided. So you'll notice again that it is a little bit of a mix there, as we must be basically cautiously opportunistic is probably the best way to put it. Now, as we move through, some of the things that you're looking at, again, consumer staples, like I said, financials, we love healthcare, and you'll see a lot of healthcare names that we won't get on this telecast that are in your strategies, and those continue to outperform and do well, and that is where we are deploying assets. Now, drum roll, please, as we come into the Fed week, as we'll review next week, how Jerome does. But I think it's already cooked in, like we called a couple of months ago, 75 basis points, right? We called it right before September, double play after the previous one earlier in August. We're looking at 75 basis points again. That's already cooked into the market. What will be the narrative? So we want to pay attention to what Jerry says about what the Fed is going to do as far as how attentive they'll be to data and essentially seeing how all these rate increases affects the economy. So of course not just domestic, we've talked globally as well. Now, beyond that, of course, you've seen your major institutional CEOs also talking about how recession is already here. Again, GDP did flip up, we saw over the last week. However, we are looking at inverted yield curves as these rates increases start to take hold and the slowdowns will take place. We've seen that with home sales, and we've seen that, of course, across retail and consumers in general who are being more tightly squeezed as far as their budgets as well. So it's just how deep will the recession be, and many project it will be cavernous. Of course, it's too soon to say. I won't project that, except that we called recessions back in June. We've had rolling recession since, and we have had a little bit of an uptick here in the GDP, so we shall see how that progresses. So as we summarize, again, we are poised to take advantage of some of the seasonal strength, but at the same time, with a quick foot by the brake pedal, being cognizant that in bear markets, and I'll finish on this, generally those geopolitical macro trends can slap the market hard in these type markets where it's very vulnerable. So we have to watch, again, for those large swings. Not only that, but after two legs down, within this death saw, if you will, technically of the market, the third and final leg, generally final, usually moves in three waves to the downside, without getting too technical, is sometimes the harshest, where some of the largest losses. And if you look back to the tech bubble and the financial deleveraging, that was the case, which is why, again, if you wonder, even during the recent upswing, why you have a lot stowed away in more conservative assets, that's exactly why. We have to look at the, kind of the International Space Station view of where the market is and where we see the financial tectonics and those plates shifting. With that being said, hopefully by the time you see this, you would have enjoyed your weekend. Mine is spent mostly researching, and TV's on mute, but I am a visual, so I'll just pick up things here and there. With that being said, we appreciate your time, patience, and most importantly, your trust. Until next time, stay frosty, and we'll talk to you soon.